All right, everyone, I'm back here for another video. So if this is your first time on the channel, hi, my name is Alex Temis. I've been day trading for 10.5 years, and I made over $8.7 million trading, and we'll pop up my broker statements on the screen right now. So in today's video, I'm gonna talk about the 8 mistakes that all brand new traders make and how you could fix them. So let me tell you about the first one, oversizing. So oversizing pretty much happens from being greedy in the markets. You wanna make money as fast as possible, and you think that the best way to make money is to get bigger on your stocks. Well, the reality is that's only somewhat true. You want to get bigger when the opportunity is there. It's like what I talk about in past videos, like the Bow and Disney World example, those A+ setups. When those A+ setups come, that's when you want to size up exponentially. But what ends up happening is in the meantime, until those setups come, you are in way too big based on your account. For example, people that have like a $10,000 account, a $20,000 account are going in massive, highly leveraged positions to be able to make big money in the market. But what I've found out is the less size you use, the more money you can make. But Alex, how is that possible? Well, it's because when you use less size, you are less emotionally attached to the stock. These days, brokers give you 4 times leverage. So on a $100,000 account, they give you $400,000 in buying power. The stock just has to move 25% against you, and your account is wiped out forever. And 25% is when a $5 stock goes to $6.50, right? The reality is that when people are using high leverage, and they are oversizing on their trades, and they don't even give themselves the opportunity to let the trade play out. The reality is stocks fluctuate, right? It's not just straight down or straight up. They consolidate, they bounce, they do this and that. And if you're in too big, you might panic yourself out before you get the directional move that you're looking for. So less size will lead to more profits because you will be able to capitalize on a bigger picture move with less emotions involved. So the next one is called overtrading. This happens when you don't make enough money trading during the day, then you keep pushing and pushing and pushing to hit some sort of arbitrary target in your head. For example, let's say your target in your head is $500, right? There's been many times I've been up $497 and I don't walk away and I say, you know what? I want to hit that $500 mark, right? What ends up happening is I place stupid trades or I place boredom trades to try to hit that number, to try to make $3 more, to hit that magic $500 number that doesn't even matter. And what ends up happening is I lose $1,000 on that trade. So now all of a sudden I tried to make $3 to hit this magic target and I lost that plus more, right? Or when you show up to the market and your opportunity is not there, your ideal setup is not there, what ends up happening is like, well, I'm at the desk. Maybe let me go see what Tesla's doing today. Let me go see what Apple's doing today. Maybe I should try to trade some Bitcoin, right? So you end up over trading and taking stupid trades just because you show up to the desk, when in reality, if your opportunity is not there, your trade is not there. So a lot of traders that show up and their ideal setup isn't there for the day, they start gambling on stocks that they're not even familiar with. It's like if small cap trading is like basketball, large cap trading is like soccer. They both involve a ball, but one of them requires your hands and one of them requires your feet. It's a totally different game. So if your opportunity is not there, or if you're trying to hit some magical arbitrary target in your head that doesn't matter, do not do it, because chances are you're gonna lose way more money than you should trying to hit this stupid number that doesn't matter anyway. The next thing is knowing when to walk away from the markets. But Alex, don't I make more money the longer that I trade? The answer is no. The analogy I like to give people is like trading is like the casino in one aspect. Do you make more money the longer you play in the casino? Or do you make more money when you walk away from the tables? The stock market is designed to take money from uneducated people into educated people. And in this case, it's the algos and the robots. So the longer you are participating in the market, the more opportunities these algos have to trap you and take your money. So when I first started trading, me and my mentor Bao, we would make money every single day from 9:30 to 10:30. And then at 10:30 a.m., we would start gambling it away, trying to make more money and compound gains. But what we ended up realizing is that after 10:30 a.m., the volume shrinks and the algos take over. So for a short bias trader, we call that zombie times because these dead stocks come back to life. So for me, I used to watch Bao make $10,000 every single day, and throughout the morning, he would lose $2,000, $3,000, $4,000 because of these zombie moves. So I thought to myself, you know what? If I just walked away and didn't lose that money that I made this morning giving it away, I would have an extra $4,000 a day. An extra $4,000 a day is $1 million a year. So we created the zombie rule, which means that you walk away at 10:30 a.m. every single day if you are a short bias trader. If you're a long bias trader, there's plenty of edge and plenty of time to make money after 10:30. But for me, recognizing that I had to walk away from the computer screens to make more money was something that I never knew, because I always thought that the longer you traded and the more you participated, the more money you would make. But the reality is you actually make more money by not losing it to the market in the middle of the day. Now, the next thing I learned is about wiring out your profits. When I was first starting off in my trading career, I wanted to be the guy that had the $1 million account, the $10 million account, the $100,000 account, right? And what I realized when I got to that level was that it is too much risk to keep all of your net worth and all of your money in your trading account. Because the reality is you, as the operator, can be flawed. All it takes is for you to screw up one time, to be in one bad stock, to emotionally endanger yourself one time to lose that all. So for me, what I realized is I don't want to have all of my risk and all of my net worth in my trading accounts. Every time I have a big win or every time I have a solid day, I wire out that money and put it into my bank account. This de-risks me. This means that, God forbid, if I have a bad day trading, at least I have a nest egg in the bank. So for me, recognize that whenever I hit a certain profit target in my trading, that I wire out money. For me, it's taking a $35,000 account and taking it to $50,000. I would then wire out $15,000 and give that as a paycheck to myself for a job well done. So these days, I don't keep my accounts at $100,000, $500,000, $1 million. I keep my accounts around $30,000 to $40,000. Every time I make $10,000 or $20,000, I wire out and put it into my bank. This way, I am not risking myself by having so much money in my trading account that I start playing the cushion game. And the cushion game goes like this. Let's say you're down $1,000 on the position. You think to yourself, all right, well, I made $1,000 yesterday, so let's just see what happens. And that $1,000 loss turns into $5,000. And you're like, well, I was up $5,000 this week, so it's fine. Let's see what happens. And then it goes down to $10,000. And you're like, well, I'm up $10,000 this month. Like, let's just see what happens, And then it goes down to $50,000. And you're like, well, I'm up $50,000 for the year, so let's just see what happens. And then it goes to $100,000. You're like, holy shit, like this is all the money I made from trading, and now it's all gone. So the less money you have in your trading account, the more risk averse you're also going to be, because you're not going to let these losses balloon. If you have a $1 million account and you're down 20 or 30,000, you're like, let me just see what happens. You start playing the cushion game. But if you only have a $50,000 account and you lose 25,000, that's half of your account gone. You cannot risk that. So for me, wiring out money out of my trading account and into my bank account has been the saving grace, because it takes stress and pressure away from me as well, because I have this nest egg in the bank that I can rely on when there's a rainy day. So the next thing that ties into that is diversifying your income outside of your day trading account. So now that you've wired out profits, what do you do with those profits? So for me, I know that 95% of hedge funds cannot beat the S&P 500. So what I like to do is I like to take some of my money that I wired out and put it into the S&P 500. I like to take some of that money that I wired out and put it into real estate. I take some of that money out and I put it into crypto. I take some of that money out and I put it into venture capital. So by diversifying my income outside of trading, I am now making money while I am asleep. I am de-risking myself and setting myself up for retirement at an early age, because I'm taking that money out of the bank and putting it into income generating assets. And you might think to yourself, but Alex, why not just keep the money in the bank and let it grow? The reality is you're losing money to inflation every single year. So I personally only like to keep a small amount in my bank account as a safety net, just in case I need it. Otherwise, I take that money that I wired out and diversify it into other income generating assets, right? I like to diversify about 20% of my wire out. So if I wire out $10,000, I keep $8,000 in the bank and I'll diversify $2,000. That way I am protecting myself and keeping a good amount of money in the bank account just in case. And so what if that little amount loses money to inflation? I will combat it with my investments. So I highly suggest to diversify your income outside of the market once you start wiring out. And the last thing, the most important thing, is you have to be patient in trading. The thing about trading is you can make more money than a doctor, a lawyer, and an engineer combined in one day. I've done it myself. We'll pop up some of those six-figure profits on the screen right now. And the thing is, you have to understand that a doctor goes to medical school for 8 years. A lawyer goes to law school for 6 years. An engineer goes to school for 4 or 5 years. So what you have to understand is if you want to make more money than all these people combined, you have to go to trading school, right? That's what we're doing right here, right now with this video. This is trading school. The difference is you don't have to go to trading school for 8 years. You don't have to go to trading school for 6 years. You don't have to go to trading school for 4 years, but you do have to go to trading school for a couple months or 1 year. And isn't that trade-off still worth it? Isn't it worth trading 6 months to a year, learning how to do this the right way, and making more money than a doctor, a lawyer, and engineer combined in less time as well? But the main thing to understand is you have to be patient and invest a little bit of time into understanding how to do this properly, and then the rest is history. The sky is the limit. So that's it, guys. These are the 8 lessons that all brand new traders make and how to fix them. So leave a comment down below if there's a lesson that you think I missed. Leave a like, leave a comment, subscribe to the channel, and let me know what you want to see on the next video. I'm also going to include some live trading videos here, some more videos there, and remember to subscribe to the channel here. I'll see you on the next video.